Well, good afternoon, everyone. I'm Steve Bruno. I'm the Chief Investment Officer at 12 Points. I am pleased to welcome Mira Pandit, who is a member of the team at JP Morgan Asset Management. And Mira is going to take us through JP Morgan's guide to markets for 24 and 25. I'll turn it over to you, Mira.
Great, thank you. Thank you all for joining. Thank you for having me today. We released our year ahead outlook just a few weeks ago. So it is outlook season. And if we think about this time last year, what we were predicting for 2024, we predicted a pretty benign economic outlook. And actually, that's the same for 2025, where we still expect growth to be reasonably strong, inflation to continue to dissipate very gradually, and the labor market to be pretty strong. The big swing factor this year potentially is policy and how those policy decisions might end up stoking stronger growth, potentially stronger inflation, and potentially a tighter labor market. So if we take a look at the next slide, let's start with economic growth. What we can see on this slide here on the left-hand side is real GDP growth on the gray line there, and also trend growth of how fast the economy usually grows in blue. So typically our economy grows around 2%, and yet what we have been seeing in 8 out of the last 9 quarters is above trend growth. And that is owing to all of the major engines of the economy, which you can see on the right-hand side. So when we look at the composition of what drives the economy, almost 70% of that is consumption. And consumers continue to spend. Perhaps underneath the surface, the makeup of that is a little bit different, and that composition is a bit different in that you've gone from lower income consumers doing all the spending to higher income consumers being the big spenders. You've gone from goods to services to both, to consumers being a little bit more judicious on both fronts, but nonetheless, consumption is still very strong. You also saw in green government spending continuing to be very strong. We're on track to notch another $2 trillion deficit in the upcoming year, and state and local government spending has been very strong. And then finally, that top category, the other one that's reasonably sizable is investment X housing. Businesses continue to spend on AI tools, enhancing productivity, taking advantage of various subsidies that we have seen from the government, whether it's the CHIPS Act or the IRA Act in the last couple of years. So all of those three major actors, businesses, consumers, government, continue to spend. We would expect somewhat of a moderation in some of that spending into next year, resulting in closer to trend growth. But what we have consistently seen in the last couple of years is some upside risk to growth, where we potentially could see things come in, continuing to come in reasonably strong. So growth backdrop is solid. And a big reason behind that, if we take a look at the next slide, again, if consumption is almost 70% of the economy, well, the worker is the consumer is the worker. If people broadly have jobs, then that should help support consumption. And what we can see over on this slide here is the unemployment rate around 4.2% has been not only very low relative to history, but stably low, because essentially it has hovered just around 4% for the last 3 years. So that stability and predictability of the labor market has been very helpful for the worker. We have seen things come into a better equilibrium. Back in 2022, there were 2 job openings for every 1 unemployed person. Now that is no longer the case. It's more of a 1-to-1 ratio, but nonetheless, a pretty good environment if you are a worker. The other thing contributing to that and helping out from a consumption standpoint is that blue line, where we look at wage growth today versus wage growth 1 year ago. And where we are is a situation in which that wage growth continues to outpace inflation. So people are earning faster than their costs are going up. So that positive real wage growth has also helped to support the consumer. Now, the flip side of wages is for a long time they were accused of stoking higher inflation, but even the inflation picture is becoming a bit more moderate. So if we take a look at the next slide, This slide shows inflation over time, both headline CPI, broad measure of different goods and services in the economy, and then core CPI, X food and energy in that gray line there. And you can see that very sharp spike up in inflation and that very sharp receding of inflation as inflation has broadly come under control. But we're kind of stuck here at the last mile, where trying to get all the way down to 2% has taken us most of the last year and probably will take us most of the next year in order to get all the way down to the Fed's 2% target. Now, the good news is back when we saw the inflation spike and when it peaked, the sources of inflation were pretty broad-based. You'd find inflation in all goods and services pretty much. And at this point, it's in some very concentrated areas of the economy. So it's not everywhere, but it is in certain places like shelter, for example, rents, auto insurance. While those areas aren't going to dissipate entirely, as we start to see them come under gradual control over time, that should help inflation come down further. But of the three areas, growth, labor market, inflation, the area where I see most risk is potentially inflation, because what we have seen is we're not making as much progress as we had been. Again, that last mile is always a little bit tricky, but we do expect that in fits and starts, we should gradually get closer to the Fed's 2% target. However, policy is a big swing factor here in which it is possible that you could see inflation tick a little bit higher from where it is. Nowhere near what we see in earlier parts of this page where you see a huge spike, but nonetheless, you could see a bit of an increase there if we see things like tariffs, which if you consider that of the basket of consumer goods, if we consider that blue block of consumption on the other page, about 17% of that is imported goods. So if goods become more costly, that could put a bit of upward pressure on inflation. But overall, reasonable economic backdrop in which growth has been above average, the labor market is tight, and inflation has come down quite a bit, even if it's sort of getting stuck between 2 and 3%. Now, all of that put together on the next slide has given our central bank, the Federal Reserve, the mandate to start easing a bit. They no longer have to conquer inflation. The labor market has come back into a better balance. And so they don't need to be too restrictive on the economy in terms of high rates. So this gray line here shows the federal funds rate over time and where we are today. We have had 3/4 of a percentage point worth of cuts so far this year. We are probably headed for one more cut next week, which would mean 1 percentage point off of that policy rate over the course of this, really just this past fall. Now, what we have started to see change in terms of the monetary backdrop is where we go from here. Because if you look at that blue line there, that is reflective of the Fed's expectations of monetary policy going forward relative to the market in green. And the Fed has been anticipating that we would see 4 cuts in 2025 for another percentage point shaved off that policy rate, and another 2 cuts in 2026 for a total of 1.5% lower on this federal funds rate. Now, the market has gradually started to price a lot of that out. And right now, the market is anticipating about 60 basis points worth of cuts next year. So that translates to probably 2 to 3 cuts. You know, in our view, perhaps you see a cut in March, maybe you see another cut in June on a quarterly cadence there, and then the Fed takes stock and pauses for a while. And a big driver of this is the fact that the economy is still pretty healthy. And what determines a neutral rate on the federal funds rate is a level that doesn't really interfere with the economy. It's not too high to restrict activity. It's not too low to overstimulate the economy. And so clearly right now, because we have reasonably strong economic numbers, the Fed probably doesn't have to cut as much as they originally anticipated. So I think you'll probably hear from the Fed next week that they are going to start reflecting fewer and fewer potential cuts next year, which results in a slightly earlier end to the easing cycle than we originally thought. That purple diamond there of the expected longer term federal funds rate likely coming up to something closer to that green diamond, or perhaps even a little bit higher by the end of next year. So premature end to the easing cycle. But on the next slide, it's had a very odd impact on rates. Typically, what you see is that rates are driven lower when the Fed is cutting rates, And yet what we've seen is that rates have actually moved higher. So around the time the Fed cut rates, the 10-year Treasury yield is about 3.6%. Right now, it's closer to about 4.2% just as of a few days ago. And ultimately, that's very odd and sort of counter to what we would typically expect if we were dusting off the Fed is cutting playbook. On the one hand, as the Fed continues to cut, that should put downward pressure on yields. But what has really been putting upward pressure on yields is not simply the economic data that we've seen coming in reasonably strong. I wouldn't say it's overly surprising, but really what we had seen since earlier in the fall is yields moving higher as a reflection of unbalanced federal finances. Said another way, if you are a holder of a US government bond and you see that the Fed is not balancing its budget very well, you start to want to get a little bit more compensation for holding that bond. And so that has put a bit of a floor on how much yields have come down. So it's a bit of a push and pull when we think about monetary and fiscal policy on the direction of yields. So if we dive into that a little bit deeper on the next slide, this slide looks at our federal finances, and on the left-hand chart there, you can see our 2024 federal budget. We spent almost $7 trillion and notched a deficit of about $2 trillion of which we borrowed. And if we think about some of the headlines, well, this could all change next year because we're going to see massive government efficiency and a whole lot of spending cuts. The challenge is there's fewer places to cut from than you'd think. And that sounds odd because $7 trillion is not a couple of places that you can skim. The challenge is that there's a lot of non-discretionary spending here, a lot of mandatory spending here. You look at on the left-hand chart, Medicare, Medicaid, Social Security, net interest payments in blue. You essentially have to make those payments. Even in that other category, there are some mandatory benefits factored in there as well. You could cut a bit from defense. I don't think the new administration has a whole lot of interest in doing that. So you're sort of left with a bit of that non-discretionary in purple and a bit of that other in gray. So all told, maybe a quarter of the budget are areas that you can actually meaningfully cut from. So while $2 trillion is a good goal over the course of a decade to cut, it's not likely that in 1 or 2 years that's achievable. If we also think about raising revenue through things like tariffs, last year tariffs accounted for about 1% of our sources of financing. So if you look at on the stack chart, the second set of bars there, there'd be a tiny sliver for tariffs of 1%. So even if you raise tariffs, 100 times, it's still not going to produce, or you'd have to raise tariffs effectively, many, many multiples of what they are today in order to get to a reasonable dent in terms of sources of financing. You can see again, corporate taxes in and of themselves are only 8% of the financing. So all of that is to say, some of the proposals for balancing and right sizing our budget are not quick fixes and are not going to solve problems within a year or two. We'd have to have a whole decade of that type of behavior in order to right size things. Especially because if you take a look at the right chart, not only is our deficit set to rise, but if we see a full extension of the Tax Cuts and Jobs Act, which we are likely to see, that could likely result in even higher of a deficit. So you can see on an inverted scale, our deficit on the right-hand side between, right now it's about 6%, between 5 and 7% over the next decade. That's going to move even a little bit higher to between 6 and 8% over the next decade. And what's interesting about that is a lot of it has to do with the fact that rates are higher. So in blue, that's just the net interest portion on the top right there. So it's not even the actual spending that's pushing up government spending. It's really, and the deficit overall, it's really how do we finance that? But over time, higher debts, higher deficits, we will try to offset some of that with tariffs. But again, you could see some inflation and slower growth coming out of those if things become more expensive for businesses and consumers. And certainly with tax reform, while it's likely to be a bit pro-growth, particularly in 2026 when various tax cuts are extended and potentially more are added to that. But again, that's going to really push up the deficit over time. So that, all in all, will likely keep, again, a bit of a floor on how much bond yields can go down, even though the Fed is cutting. Now, if we take a look at the next slide and think about investing in this environment, it's been a really blockbuster year. The macro backdrop, as I had mentioned, is strong when we think about growth, jobs, and in progress on inflation. The Fed is easing, and we do anticipate all of these things to continue into next year. Even if we do have some policy swing factors, for the most part, they should be pro-growth, potentially push up inflation a little bit more, potentially tighten the labor market a little bit more if we think about immigration reform. But a pretty solid backdrop means that we have had extraordinary equity market gains and could continue to see that into next year. So when we think about the investing environment, it actually doesn't feel like a great time to put money into the market. You feel like you're buying something expensive. You feel like you're buying something at the top. And while stocks are certainly expensive right now, to some extent you get what you pay for because we have had two back-to-back 20 plus equity market years, something we've only seen about 4 times since the late 1800s. So pretty rare to have this type of back-to-back year. So again, feels good to be invested in the markets. Does it feel good to be adding to the markets? Well, while it probably doesn't, what we've actually seen over time is that market momentum begets more market momentum. So what we've seen on the left-hand side is we've had 57 new all-time highs this year. And that stock market over time, you can see in green there, the clusters of all-time highs, they often cluster together. And that means that, today's all-time high is tomorrow's old news because there could potentially be another one. And actually, about 30% of the time, that all-time high sets a new market floor. So we don't retrace that value and go down below it. We continue to move forward from there. And that momentum begetting momentum really adds up over time. What you can see on the chart on the right is the average cumulative S&P 500 returns if you invested on any day or specifically at a new high. And again, because those highs are potentially old news the next day as new highs are achieved, that's actually why you actually, over a longer arc of time, can potentially see higher returns for investing on an all-time high. Again, that momentum begetting more momentum. So even though it doesn't feel like a great time to be putting new money to work, it's actually certainly not that bad of a time. And when we think about not only the entry point, but also the environment we're in, if we take a look at the next slide, we know that the Fed is cutting rates. Even if they don't cut as much as we anticipate, there still could be some room to run here. So what we look at on this slide here is stocks on the left, bonds on the right, their performance around previous Fed cutting cycles. And you can see the performance anchored in that first cut there. So where we are so far in 2024 is, again, still kind of on target, early innings when we consider what we could potentially see in terms of returns ahead. Now, we certainly don't want to promise that the returns on the top, anything could happen, and we're probably not going to see, again, that many cuts next year as we might have anticipated a few months ago. But nonetheless, there is certainly some room to run here if we think about stocks, and certainly if we think about bonds on the right, where yields have actually risen, meaning bond prices have actually come down since the first cut. If we take a look at the next slide, I do still don't want to sound too Pollyannish and too optimistic about everything. Let's acknowledge the risks. We acknowledge some of the risks around federal finances and budget longer term, and how that might play into the bond market. In the equity market, we do want to be mindful of valuations and just how expensive things have gotten. Again, new all-time highs can beget new all-time highs, but that price tag is not cheap either. And in fact, if we look at the S&P 500 as a whole, it's about 33% more expensive than its long-term averages. A big portion of that, though, is driven higher by those top 10 stocks. That includes your Magnificent Seven and a few other star performers this year. Those collectively are 45% more expensive than long-term averages. And you can see that divergence there between those top 10 stocks and their valuations relative to the rest of the market in gray. Still, again, somewhat higher relative to history, but not quite the heights that concentrated number of stocks are doing. And that concentration does also bear a risk for portfolios because, valuations to some extent are reflecting price momentum. What goes up can come down. I'm not saying that it will or it will in a hard way or anytime soon, but we have to be mindful that market volatility does exist. And when you have a high level of concentration in a small level of stocks, sometimes you can feel that in a portfolio more. So that right chart there looks at the weight of those top 10 stocks in the S&P 500 is nearly 40%. And if you look over time, that is far exceeding some of the concentration we experienced during the dot-com bubble. So that's essentially record high levels of concentration, something we want to be mindful of. What that also means is if you were in a balanced portfolio, a 60-40 portfolio, 60% stocks, 40% bonds in the beginning of the year, given the bond market performance and certainly given a very concentrated equity market performance, you could be, somewhat far away from that 60-40 allocation. So we do want to be mindful when we think about rebalancing to get back to those neutral levels. So we're not too far off course when we think about our long-term investment plan. Now, I don't want to beat up on those top 10 stocks. They certainly have a place in a portfolio. And if you look at the economic concentration of those, when we look at the investment for the future, the cash flow they're bringing in, the income they're operating with, the sales, it's still a very concentrated portion of the index as well. So they're certainly pulling their weight, but we don't want to own just 7 or 10 stocks because we do want to manage if there's volatility, not necessarily facing as harsh of a drawdown. And we also want to manage the idea behind high valuations and how much room to run there can be at those levels. So on the next slide, what we're really trying to anchor ourselves in is sticking to that investment plan and being appropriately diversified. So this slide here looks at a top to bottom ranking of different asset classes in the market. And then we make a composite in that white gray box there that is essentially a 60-40 diversified portfolio with all of these asset classes in it. And what you can see over time is often the best performing asset class one year is the worst performing asset class the next year. So even for the best investor, it can be hard to predict the winners and the losers each year and then consistently be right about that. That's why being diversified can help because you get exposure to some of those top performers, capturing returns on the upside, but you're also able to protect those returns by protecting on the downside. So you can see that white box kind of cutting down the middle of the slide there. We connect it with that black line, delivering that smoother ride over time. So you're not looking at your statement month after month, quarter after quarter, and seeing massive movements. So with that, I will pause there and happy to answer any questions.
Great, thank you very much, Mira. I'm going to first of all open up to questions from the audience via the, I guess, the software. You guys can type questions in, and Mira and you can see the questions as well, Mira, can't you? Or as they come in? You're muted, Mira.
Oh, I'm sorry. Yes, I can. I have a little chat box. So I'll be able to see them.
Okay, so both of us can look at those questions as they come in. But as to get things kind of kicked off, we obviously spent a lot of time talking about the U.S. U.S. stocks represent, probably at this point 70% of the global, equity weighting. How about the rest of the world?
Yeah, international stocks have really struggled in recent years relative to the US, and they've become quite unpopular. What I would say to that is it's not about investing in international economies, because a lot of macro risks are out there. You can, saw martial law declared in Korea. We saw a no confidence vote in France. We've seen all sorts of poor macro headlines in different countries. But yet, a lot of companies have come out unscathed and have done reasonably well in that backdrop. So the macro doesn't always equal the markets. So the way I think about investing internationally is think about some of the themes that are working in the US. Think about how high the valuations are. And because of that macro environment in other countries, the sentiment can be poor, and you can actually find very similar companies and business models with lower valuations. So I think about areas like European biotech, healthcare, some of those big weight loss drugs. I think about emerging market technology when we think about semiconductors, chip manufacturing, some of that advanced technology abroad. I think about European luxury goods. If you're going to get a gift for someone and you want something fancy over Christmas, that brand is probably going to be European. And a lot of those stocks have kept pace with different growth stocks in the US. What I'd also point out is, again, you can't just own 7 stocks or 10 stocks. And so if you look at the top 50 performing stocks worldwide, 35 of them are not US based. And actually, about 3/4 of those are based in some of those other developed markets like Europe, Japan, where really only Japan has gotten good headlines this year outside of the US. A lot of other countries have not. And yet, again, 35 of those stocks out of 50 of the top performing worldwide are not based in the US. So definitely some opportunities there. I think we just have to narrow our vision and narrow our lane and really look for good companies with good business models at attractive valuations, of which there are, relative to investing wholesale in Europe or Brazil or India or whatever the case may be.
So I guess the same question on the fixed income side of the ledger internationally.
Internationally, the U.S. bond market is only about 40% of the global bond market, so huge opportunities internationally as well. I think that there's two different outcomes you're looking for with fixed income. One is downside protection, another is yield. Now, from a Fed perspective, it looks like the Fed might cut less than a lot of other major central banks, so you could potentially still see better yields within the U.S. relative to the risk they bear, relative to other parts of the world. So I think from an income perspective, certainly there's still a lot of opportunities in the US. But if you look at corporates across the world, whether it's investment grade or high yield, you actually see some pretty decent yields as well in areas like Europe, where even though you might see rate cuts further than the US, you're still actually continuing to find some pretty attractive yields within the corporate side of the balance sheet. And then if you think about, again, downside protection, the US is not necessarily the only name in the game in terms of some of that area where you might pick up a bit of duration. If you're looking at high quality, you can find high quality in other places as well. So wanting to diversify internationally, I would say the caveat to that is the Fed's probably going to cut less. Yields might be a little bit more attractive here, but you're seeing a whole lot of rate volatility that is making the protection aspect of fixed income a little bit more challenging. For a long time, stocks and bonds moved in opposite directions. So when stocks suffered, bonds protected. That relationship has somewhat broken down since the pandemic. So I think we want to be mindful that from a fixed income allocation, especially when we think about the Fed cutting rates and rates actually moving higher, the playbook is not as straightforward. So diversification can help balance some of those different objectives out.
Great. Again, if anyone has any questions, feel free to type them into the chat box. We've talked about obviously equities, both domestic, international. We talked about bonds, domestic, international. One of the things I think JP Morgan is especially good at, frankly, is the alternatives markets. You guys do a similar outlook for alternative asset classes. Maybe we could spend a few minutes talking about that, because that's something that, at least from 12 Points perspective, is near and dear to our hearts as well.
Sure. On the alternative side, I think that some of your best opportunities going into next year will probably be around infrastructure and private equity. And the reason I think that is, one, on the infrastructure side, look, I mentioned the breakdown in terms of correlations with stocks and bonds over time. So we're looking for diversification. You've seen uncorrelated returns from infrastructure, and you've also seen really healthy, stable income really anchor the return profile of infrastructure overall. There's also such an enormous demand. About $3.5 trillion globally is needed to maintain and upgrade our infrastructure, or about $100 trillion over a 25-year period across the world. And you're seeing that demand everywhere. while you have seen governments show more of a political will to spend on infrastructure, where that political will meets fiscal realities, it is challenging because governments are probably not going to have the money to spend that they want given high debt and deficits, not only in the US, but across the world. So if I think about that demand needing to end up somewhere, it's probably going to end up with private infrastructure operators. Now, it's not just the demand there, it's also, what are some of the trends underway? Data centers, AI. If you think about powering AI with data centers, that's going to require electricity and a lot of it. And while electricity demand has really flatlined over the last 20 years, we expect it to tick up with greater electrification of things like data centers, of things like electric vehicles and their charge points. So I think that those are some of the areas where we could see a good degree of growth and opportunity within infrastructure. On the private equity side, the big story for the last few years in private equity has been there's just no ability to exit some of these investments and realize the gains that private equity operators have made with some of their target companies. I think that will likely change in the year ahead when we consider uptick in M&A and IPO activity spurred on by potential deregulation or promises of tax reform on the corporate side potentially. So as we start to see more liquidity in the market and greater avenues for exits, that could become a more attractive time for not only a private equity operator, but also as you're looking for target companies and trying to grow organically your companies, just a generally benign environment when we think about revenues, margins, and the profitability of some of those underlying companies.
Perhaps we could spend a few minutes just on your outlook for the very short end of the fixed income market, what might happen to cash rates. And we know there's about $7 trillion sitting in cash in the US. And as the Fed continues to lower rates, what might happen to that cash?
I think what's likely to happen when we think about the shape of the yield curve is we're probably going to see things get a bit flatter. So you could still see that short-term rates come down a little bit more to match where the Fed gets to. Not a whole lot more, given that they've already come down a bit, but you probably see that short end of the curve come down a little bit and overall a reasonably flat yield curve. Again, I think based on some of our federal finances, some of the fiscal fears, the longer end of the curve is probably going to be propped up close to where it is or experience a little bit more of a support. But overall, looking for a flattish curve and 3.75 to 4% on the 10-year, given where the Fed is probably going. That being said, when we think about opportunities from a cash perspective, as you are rolling forward those CDs, that the return that you're going to lock in is going to get likely less and less. And we have a great slide in the guide that looks at locking in the peak CD rate and your subsequent return a year later. Fixed income beats in every prior Fed hiking cycle because you get not only the benefit of higher income that you've locked in, but also as yields come down, that price appreciation. So cash is just gradually becoming a less and less attractive place. I think we're going to continue to see people kind of come off the sidelines from a cash perspective, especially given potential for double-digit profit growth again next year and forecasted into the year after that.
Great. So just to interject my view a little bit here. I mean, one of the things that I'm concerned about as we look out is what I perceive as just a general complacency over inflation, both domestically and to a certain, mostly domestically, somewhat globally, but mostly domestically, in terms of what the markets are discounting. Now it sounds like you have a more sanguine view on inflation.
I think we're a little bit stuck where we are, but you could continue to see progress over the next 2 years. Again, it's a slow timeline to get all the way down to 2%. I think it's achievable. As I mentioned, I do think that policy risk around tariffs, debt, deficits could put some upward pressure on inflation. But even if we see a reigniting in inflation, we start to see inflation creep up. I think that the higher inflation would be closer into the 3% range as opposed to 5, 6, 7% that we were seeing a couple of years ago. And I think that that would be paired with higher growth. I think that inflation's more of a concern when your growth is not keeping up, when your consumers are falling behind, when your wages are falling behind inflation, when people don't have jobs. Because that is all not the case. I think it can be stomached, but yeah, I think that that's why you're also seeing some of those cuts priced out of the market, and probably a Fed that's not going to cut as much as they said they would, because there really isn't as much of an impetus to. We're not seeing rates slow the economy, so why go much lower than where we are today? And I think that that can help at least maintain a more stable inflationary rate.
So if we leave inflation for a second and we just look at the risk side of the ledger, and this would sort of be my final question. Again, if anyone has any questions that they'd like to type into the box, please feel free, and we will most certainly get to them. You know, obviously we can't anticipate everything. There's always a chance of a black swan out there that sneaks up and catches everyone by surprise. I mean, what do you think might be, you know, some of the risks that are out there that the market is underpricing in terms of its outlook, whether it be domestically or internationally?
Look, I think some of the things I highlighted in terms of higher valuations, high index concentration, 2022 was not that long ago when you saw the very high concentration of tech companies within the market down 40% relative to the rest of the stocks in the index down only 8%. So I think we do need to be mindful of concentration and valuations. I think that, as you highlighted, inflation could be a risk there, because the risk that stems from that is, does the Fed have to hike again, and turn around in terms of their monetary policy? That, of course, is still a risk, not our base case, but it's out there. Policy uncertainty and what that does, not only around debt and deficits, but if you're continuing to hear, sort of tit for tat trade war, does that weigh on sentiment and the willingness for businesses to invest if there's that level of policy uncertainty? So I think all of these various factors are ones to watch.
Wonderful. Mira, thank you very much. We very much appreciate your input. And again, I call out the wonderful work that JP Morgan does for their annual outlook. And, if telling tales out of school, it's actually one of the inputs that we use to gut check our own estimates in terms of expected returns and the like. So again, thank you, Mira. And thank you all for joining us today. Appreciate it. Well, I guess we'll see you same time next year.
Thank you so much.
Thanks.